Well, welcome to our webinar this afternoon on inflation. Thank you all for attending. We appreciate your attendance. Jesse and I are going to talk about inflation just in a conversational format and try to help you learn about inflation and learn about how to protect your wealth from inflation. We can't take any questions during the webinar, or we're not gonna, but there's a chat feature at the bottom of your screen that you can, if you have a question, you can type it in, and at the end of the webinar, we'll see if there are any questions there, and we'll answer them for you. Also, of course, you can always email Jesse or I, jesse@bobbenny.com or bob@bobbenny.com after the seminar, and we'll answer questions for you. So the mainstream media and the government aren't talking too much about inflation. In fact, they're downplaying it. They're calling it transitory, meaning that it's a transition because of the pandemic and some of that kind of business. But that's not true. We are on the verge of I think, pretty high inflation. Don't trust the mainstream media or the government. That's kind of the moral of the story that we've kind of been experiencing in the last few years anyway. And where the mainstream media hasn't been talking about, the financial media has been talking about inflation. So Jesse, what's the definition of inflation? What would you say your definition of inflation is?
The rising cost of goods and services.
The rising cost of goods and services. I think that's the perfect definition of inflation. What's the difference between what would be, because we always have a little bit of inflation usually. What are the rates per year of normal inflation versus high inflation?
I think the normal rates are between 2 and 3%, and high inflation is inflation that outpaces your increase, a natural increase in like income. So like 8 to maybe 12% would be high.
Right. And do you know what the definition of hyperinflation is?
Hyperinflation we have not experienced here, but they have in other countries, more unstable countries. But hyperinflation, I think, is inflation that's 50% or higher in 1 year.
Like Venezuela, 200% in 1 year, that sort of thing. Hopefully we'll never reach anything like that, hyperinflation. But I mean, I personally consider high inflation to kind of be hyperinflation.
One of the next questions that I have is, I have never experienced inflation before really in my lifetime in a tangible way as I am right now with everyday things that I'm buying, and it being a noticeable thing. Have you experienced high inflation as high as what we are in now or higher?
Sure. And I'm a little bit older than you. And in the late 70s, early 80s, we were having very high inflation. Many of our clients were around back then and remember, everything going up and interest rates going up, and it really made life difficult because the cost of things we were buying, whether it was houses or cars or gasoline, was going up at a faster rate than everybody's income was, and so it made things very difficult. So Jesse, what are some examples of right now that you've been experiencing of high inflation?
Well, I've noticed gas prices, and I've noticed higher prices of things at the grocery store. And I just bought a new used car and ended up having to pay over the Kelley Blue Book just to get it. Almost got bought from underneath me in that short amount of time.
Yeah. But so, I think about gas, for heaven's sakes. A year ago, I was paying under $2 a gallon for gasoline. It's barely under. But now my most recent fill up in my truck was nearly $3 a gallon. Well, from $2 to $3 is about a 50% increase in the cost of gasoline in a year or less than a year. Um, we have some clients that are in the trucking business. Some are truckers, some are executives in the trucking companies. And they're telling me that the rates for trucking, for transporting goods across the country back and forth have been going up 15 to 20% in the last 6 months or so. Another thing that's clear is the rising price of houses. It's going through the roof. People are having to offer more money than the asking price for houses. Farmland is going up in price dramatically. Commodity prices such as corn and soybeans and wheat and oil, crude oil, are going up. So inflation is here, and it's high inflation. It's not normal inflation.
So what has caused this inflationary period to start happening? Or what causes inflation in general?
What causes inflation in general is that demand is outpacing supply. And it's an economic, whatever you call it, an economic principle that when demand for items is greater than the supply, the price rises. And basically what it is that there's too many dollars chasing too few goods and services. And that causes prices to go high. Well, why are there too many dollars? There's too many dollars because, frankly, because the Federal Reserve has just been simply printing money at an accelerated rate, particularly in the last several months or a year. But it's really gotten bad in the last several months. And they're printing money for the government to spend, and they're giving it away. And so suddenly there's too many dollars chasing too few goods and services. And it's a problem that doesn't really go away.
So what would you argue to people who say that this inflation is transitory?
People, including the news media, the mainstream news media, and some government people that are saying that it's transitory because of COVID. It's either frankly just wishful thinking or they're outright lying. Inflation is happening, and high inflation is happening because of all this extra supply of money in the system. It's inevitable, and it's not going to go away. Now, maybe some things like used cars might be more transitory, and they might go away, but it's starting to affect everything, and then it ends up having a snowball effect. So, for instance, the rising cost of fuel, of gasoline and diesel fuel, increases the cost of transportation, of trucking. The increased costs of trucking increase the costs of the goods that we buy at the store, and so on and so forth. And it just becomes a snowball effect. And so
why should we be concerned about inflation, or why is inflation a bad thing?
Well, this high inflation is a bad thing because it reduces our buying power. It reduces how much we can buy for $100. For instance, if we have $100 and today we can buy $100 worth of groceries with $100, and there's inflation of, let's say, 10%. If it was only 10%, if there was inflation of 10%, then the next, when we go to buy grocery stores after that 10% inflation, we can only buy $90 worth of groceries. And unless our incomes went up by the same 10%, and they're not, that's where you run into trouble. So you have less buying power. And then one of the things that the government, the Federal Reserve, does to combat inflation once they admit that it's happening, and they've already been talking about it in their Federal Reserve meetings so that the mainstream media doesn't report about too much, but they're trying to tamp it down, tamp it down as far as talking about it. But what the Federal Reserve will do when inflation is here for sure, and they're admitting it, is they will raise interest rates. And Interest rates on mortgages, on cars, on credit cards will go real high like they did back in the late 70s and 80s that I was telling you about. My first mortgage on my first house, interest rates had gone down a little bit by then. It was 1984 or 5 when we bought our first house, and it was 8%. And I was really glad that I got a mortgage at 8% because prior to that, mortgages were like 12%. So I thought I cut a fat hog getting a mortgage at 8%. 8% now, we haven't seen mortgages that high for a long time.
So what can we do about inflation, or what can people do to protect themselves or their investments against inflation?
Sure, that's a great question, and that's probably why all of you are watching this webinar. So there's a number of things to keep in mind that I've been thinking about, because I've been thinking about inflation for a while now, but particularly in the last 6 months to a year. One thing, a simple thing, is don't put off a planned investment of something that you need. Don't put it off to the future of something that you need. If you have the money, buy it now. For instance, I know some people that needed some new appliances for their house, and it made sense to them to go ahead and buy those appliances now because they had the money, rather than waiting until the appliances go up 10 or 15% next year, if that's what it is. But they're anticipating that they're going to go up, and I think they're going to go up too. Another thing, because interest rates will be going up on credit cards, car loans, and particularly mortgages, we're at historical low mortgage interest rates now. So if you haven't refinanced your house by now, you should refinance it, because you ought to be able to get a mortgage rate somewhere in the 3.5% right now for 30 years. And you're going to feel like a financial genius in 5 years or so when you've got a mortgage that the bank or the mortgage company is stuck with for another 25 years at 3.5%, and new mortgages might be 6 or 8 or 10 or whatever percent. As far as investments are concerned, generally we can categorize investments to two categories of investments: ownership investments and loanership investments. A loanership investment, it would be a loan, which is what a CD at the bank is, or a savings or checking account at the bank. Basically, you're loaning your money to the bank and they're paying you interest on it in a CD or a savings account. A bond is a loan investment. Historically, loanership or loan investments, CDs and bonds, after taxes and inflation, have not been able to keep up. You lose buying power if you leave your money in the bank. I mean, I urge nobody to have a real significant amount of money in the bank unless they're planning on purchasing something in the real near future, because it's not growing at a rate that's going to grow as fast as the inflation rate. On the other hand, ownership investments, by their very nature being assets, go up in value generally at the same pace as inflation or greater. Ownership investments, for instance, would be companies or pieces of companies, stocks or stock mutual funds, real estate, gold. Those are ownership investments, and those kind of assets are going to protect your money from losing its buying power versus CDs or bonds. One of the things that I looked up in preparation for this webinar was what the inflation rate in the late 70s and early 80s was, and went through each of those years. And I won't go through and bore people with the details. We're talking about 11%, 13%, 10% inflation in those years. But if you had $100, or no, not if you had $100, but let's say from 1979 to 1983, the price of $100 worth of stuff would, by 1983, cost you $152. So if you had $100 worth of groceries that you bought in 1979, to buy that same volume of groceries in 1983, it would take $152. And if you just had left your money in the bank, even though interest rates had gone up, you wouldn't be able to buy as much groceries with the 150, you wouldn't have as much groceries, as much money to buy the $100 worth of groceries. Does that make sense? Sort of.
Mhm.
In contrast, if you instead of had left the $100 sitting in the bank, earning a little bit of interest, and you put the $100 in 1979, the beginning of 1979, in the S&P 500 index of stocks, the 500 largest stocks on the New York Stock Exchange, by 1983, your $100 investment in the S&P 500 would be worth $222. So you could buy your groceries that were $100 in 79, now 152, and have money left over. I want to about ready to close now, but I want to close with a story of when I started in this business in the mid 90s. I was up on the north end of town, had an office up by 27th and Superior, and I went door to door in a neighborhood called Autumn Wood. And Autumn Wood is a special kind of neighborhood that one of their covenants, restrictive covenants, is you have to be over 55 to live there. Perfect opportunity for me to go and meet people that might be potential clients. And I did. I knocked on every door, went back if they weren't home, all that kind of thing. Basically met everybody in Autumn Wood. Now this is 1995. And of the people that were the older people, the people that have been retired a while, like 20 years, the people that were in their mid 80s, say, and they retired in the mid to late 80s, and either sold their farm or rolled over their 401k where they worked to an IRA. I mean, I didn't have anything to do with it. I'm just hearing their stories. There were two categories of people. One category of people were that when they sold the farm for whatever, $250,000 or $1 million in the late 70s and took the money, they took it to the bank and invested in CDs, which were pretty high at the time. But they invested in 1-year CDs or 2 or 3 year CDs that kept rolling over, and then interest rates went back down. And now 20 years later, those people were worried. They're worried about how much is the next Social Security increase going to be, because their investment had not kept pace with inflation. Their retirement account had not paced with inflation. The other category of people in their 80s that are retired 15, 20 years before, they were worried too. I'll tell you what they're worried about in a minute. What they had done is they had invested their money in largely or partially in the stock market, in ownership investments. And now they were worried too, but they were worried about how do I get rid of this money when I die without the government getting too much of it for estate taxes or income taxes. Well, if you have two things to worry about, I'd way worry about having to pay taxes on making a lot of money than having to worry about how much the next Social Security increase is. So can you check on the screen there and see if we have any questions? Doesn't look like we do. Well, that's great. If you do have any questions, please email Jesse or I, jesse@bobbenny.com or bob@bobbenny.com. And we'd appreciate any kind of feedback that you have on the webinar, how it went, the information, any kind of constructive criticism or feedback that you can give us is welcome. We thank you very much for attending today and hope you have a great day. Thanks.